Okay, good afternoon, everyone, and welcome to yet another M3 class. So I think we will definitely start. We will definitely start. So we will start with a recap of what we have done last week. Yeah, I think last week basically we were trying to look at Google Sheet, which is the tool we're going to use in answering all the questions that we'll be doing in this semester. So I hope you all had the chance of going over what we have done. Hello, class.
Yes, sir. Yes, sir. We tried. We tried.
You're fine. Okay. And I gave you an assignment, which was a simple assignment. Who can remember what the assignment was?
Yeah, we were required to add a sheet.
Okay.
Go to B2, write your mat number.
Okay.
Sorry, first of all, when you add the sheet, then the name of the sheet should be your mat number.
Exactly, yeah.
You go to B2, put your mat number. B3, you put your name.
Okay.
If you can protect it, you protect.
Okay.
Yes, that was basically what we did.
Okay. Right. So I hope all of you have done that assignment. I can see so many people have done it as I'm scrolling. And in addition to what Mr. Cord said, I've asked you to protect the worksheet as well so that others will not be able to use your worksheet, yeah? Okay, so I've seen some people have done it, but they've not protected their sheet. Like the way I want it is like this. You open a new worksheet, give it a name, and the name should be your mat number. You protect the worksheet. Okay, so if you click open the worksheet, on the B2, you type your mat number, and then on the B3, you type your name. Okay, but in addition to that, I said you should hide your details from here. Okay.
Hello, Mr. Fofana.
Yes.
I see view only. I was not able to do it because I see only view only.
You were on view only?
Yes.
Hey, view only?
Yes.
Look at people. Everybody was on editor, right? Are you using your UTG account?
Yes, yes.
You're using your UTG account?
Yes.
Look at your colleagues. They all have editor, right? Why are you on view only?
Ali
Why are you on view only? What's your email? What's your email? Give me your email.
802183.
Sorry?
80.
80.
2183.
2183.
4089.
Is this one?
Yes.
Okay, anyway, I sent you the invite. Now you should be able to edit it, yeah?
Okay, thank you, Mr.
Fofana. Mr. Fofana.
Hello.
Can you send me an invitation so that I will be able to have access to this?
Extra 1 year deal means he'll be
Okay. Give me your email. Nima, what is this now? We are in class. Are you aware? Nima Sanyang, are you aware that we are in class?
Smarter, more smooth. VinFast's vision.
Yes. Mr. Rowan.
Yes.
Ibrahim speaking. How are you?
Hi, Ibrahim.
I'm
How are you
also
doing?
new here. I started this class today, so I would be. Would you mind? I also send you my email. You send me the.
Yes, of course.
So
We can do that.
easy.
Actually, what we will do is, if we want to do it in class, it's going to take time because I've asked those who have been added. So any of you whose name appears here can add, the others. Look at it. All these people here can add anyone because they've all been given editor right. So because I know there are still so many people who have not who have not been added here. So after class, make sure let someone among these people here add you. At least I know the class rep and the assistant class rep have been added, and other people, as you can see in here. So just make sure they add you, and then you create your own worksheet in here, please, everybody. Otherwise, we're going to use the whole class just adding people's name, and the time is not on our side. Okay, so just make sure that is done for you. Good. So right. So today we're going to move to lecture proper. Of course, we will come back to Google Sheet because we're going to use Google Sheet in all our calculations. So the more we go, the more we'll be using Google Sheet. Okay? By the time we finish this semester, inshallah, you'll all be experts in Google Sheet. Okay? So any questions or remarks you want to make before we move? Any questions or any remarks you want to make? Okay, so today actually we're going to look at absorption costing, and we will look briefly at the comparison between marginal costing, absorption costing versus marginal costing. We'll be looking at that. And hopefully we're going to do one question using Google Sheet. Okay, so what is absorption costing? And what is marginal costing? I'm sure you have done these things before. 100% you've done them before. Yes. What is absorption costing and what is marginal costing? We'll be talking about marginal costing a bit, but our main topic is absorption costing. And the next class, we'll look at ABC, activity-based costing. Okay. So when we talk about absorption costing, what do we mean? Are you with me? Class, are you with me?
Yes, sir. Yes.
Okay. Have you done absorption costing before? Have you done absorption costing before?
Yeah, we have done it before.
You have done it before. Certainly, you have done it before.
Both absorption costing and marginal costing.
And marginal costing, 100%. You have done them before. I'm sure in either your MA1 or MA2, or those who have done professional courses, AAT, CAT, you must have, done them. Yes.
Hello.
Hello, yes, Yasin, go ahead.
Absorption costing is a method of accounting which entails the full cost.
It's a method of accounting which entails the full cost.
Yes. of manufacturing or providing a service, while marginal, it consists of only the variable elements.
Only the variable elements. Okay, that's a good attempt. That's a good attempt. Yes. Anyone else want to beef it up?
May I try, please?
Yes, yes, go ahead. Go ahead, Usman.
Yeah, absorption costing. Yeah, absorption costing. I think this is a costing method wherein the unit cost of a product includes the fixed cost of production.
Okay, it's a costing technique whereby in determining the unit cost of a product, we include all the costs, of course, not leaving out the fixed production cost. Very good. That's really good. Yeah. So I think we can go ahead. That was a good one. That was a good one, Usman. Yes. So first, before we talk about absorption cost, we have to look at costing in general. Okay, costing in general. I know you've done so many costing techniques, product cost, departmental costing, service costing, and loads of different costing techniques. Okay, and the main purpose of costing, is to arrive at a unit cost of a product or a service so that we can be able to do our pricing easily. Okay, so that's the main purpose. But there are other purposes also. By costing, we can be able to do stock valuation. By costing, we can be able to use it for decision making, like short-term decision making, and costing can also be used in preparation of budgets and, budgetary controls. Okay, so costing is very, very important. And like I said, there are many costing techniques. We've got marginal costing, we've got absorption costing, and those two costing techniques are considered to be traditional, costing techniques, the absorption costing and marginal costing. By traditional, we mean these are the first costing techniques ever. And then later on, other costing techniques came to being, the likes of ABC, activity-based costing, the likes of, the likes of, how do you call it, life cycle costing, the likes of target costing, okay? So these are new costing techniques which came to being after absorption and marginal costing. But the basis for costing is absorption costing and marginal costing. And like Coley rightly said, absorption costing, the emphasis is the inclusion of all costs, that is direct costs, that's the prime cost, all fixed overheads into the unit cost of a product. Okay, so we look at them. Actually, when you look at all costing techniques, marginal costing, absorption costing, life cycle costing, target costing, and any other costing technique, the treatment of variable cost is the same throughout. The way variable cost is treated in absorption costing and the way it's treated in marginal costing is the same. The only difference lies in the overheads, how we treat overheads. Okay? So in absorption costing, overheads are absorbed into cost units, just like Corey rightly said. And stock is valued at absorption costs, and the fixed manufacturing overheads are charged in profit and loss account of the period in which the units are sold. Okay, so unlike marginal costing overheads are not part of the unit cost. That's why marginal costing technique is very useful in decision making, because in marginal costing, we don't usually consider overheads, okay? Because overheads are difficult to manage, and sometimes if you want to absorb them into product cost or service cost, it can distort decision making, especially at its short term, okay? So we can look at the comparison between the two, marginal costing and absorption costing, okay? So marginal costing is a decision-making technique for ascertaining the total cost of production, whilst absorption costing is an apportionment of total cost to the cost center in order to determine the total cost of production. Okay, so how do you recognize cost in marginal costing? The variable cost is considered as the product cost or the service cost. So in marginal costing, any variable cost or prime costs are considered to be the cost of the product or the service, while the fixed cost is not considered as part of the cost of the product, but instead it is a period cost. Okay, is that clear? In absorption costing, the way we recognize cost, both fixed and variable costs are part of the product cost, so we cannot divorce them. Okay, so that's why usually absorption costing is used in unit cost determination, so that we can be able to add a profit to arrive at our selling price. Okay, so classification of overheads. In marginal costing, the overheads are classified as fixed and variable. That's why the variable will go part of the product cost, while the fixed will be a period cost. But in absorption costing, the costs are classified as production cost, administrative cost, and selling and distribution cost. Okay, because it recognizes all costs, whether fixed or variable, so it doesn't matter for it to, it does not recognize them as fixed or variable, but instead it classifies them under production, administration, or selling and distribution. Okay, so profitability is measured on the costing, on the marginal costing, according to the volume. Okay, because everything is proportionate. Okay, the variable cost elements will always vary with the activity level being the sales quantity. So naturally, the profit will be based on the volume. So due to the inclusion of fixed costs, profitability gets affected. Okay, because fixed costs, we know there are so many things in the fixed cost. When you absorb fixed costs, sometimes you include things that are in fact notional. Okay, things that are notional. So fixed cost is distorted, and as such, it affects the profit when we look at the absorption costing technique. Okay, so the variance is so the cost per unit, as you can see, and of course the highest contribution per unit. In marginal costing, you can determine your contribution per unit, whilst in absorption costing, you can only be able to determine your net profit per unit, because absorption costing doesn't consider the variable cost in its entirety. So the variable cost is what is considered in marginal cost, and as such, you can be able to calculate your contribution per unit. And what is contribution per unit? How do you arrive at your contribution per unit?
It's by subtracting your selling price and variable cost.
Exactly. You subtract your variable cost per unit from your selling price per unit to arrive at your contribution per unit. Okay, good. So let's proceed. Now we're going to look at the uses of absorption costing. How do we benefit from absorption costing. This is really, really important, okay? In my class, I try to be as practical as possible so that students don't only learn the theories of the subject, but I always encourage students to learn the practicalities of the subject so that they can be able to apply it in real life. Okay? Accountancy is different from a lot of other professions. You know, accountancy is dynamic, is live, is happening, is real. You know, and when you have the required knowledge, you can be able to apply it to gain money without anybody employing you. Okay? So please take note as we go along, ask questions, you know, especially relating to how you can use, you know, what you are learning in real life, how you're going to apply it in real life to make a difference in your life. Okay? So one of the uses of absorption costing is stock valuation, you know, inventory valuation. Okay, we know stock valuation, yeah. As accountants, we know how to value stocks, yeah. And we know before we value stocks, those that are working knows that if you are working in a business that deals in stock, and for your information, stock, what is stock or inventory? Can someone tell me what is stock or inventory?
Yes, Mr. Fowler.
Yes, what is stock?
Stock is the materials that can be converted into cash.
There you go. So if you have a motor vehicle in your company that you use to, you know, run your business errands, can you classify that as stock?
No.
No. What is that? How will you call that?
Motor vehicle is an asset.
What asset? Come on, be an accountant. What asset?
It's a fixed asset.
Do you call it fixed asset now?
Yes, no.
Non-current.
Non-current assets.
Non-current assets.
So to say it properly, a motor vehicle is a tangible non-current asset. Okay? It's a tangible non-current asset. Okay? So inventory, just like you rightly said, Mr. Cham, it is the stock of goods in your store that are waiting to be converted to cash. So if you, and you know, motor vehicle could be inventory. When will motor vehicle become an inventory?
Yeah, if the company itself is dealing into motor vehicle, then
there
it could be an entry.
There you go. So give a typical example in the Gambia. In the Gambia, which company can call its motor vehicle as an inventory? Which one?
TK Motors.
TK Motors. Cyber El Mahdi. Cefao. Name them. Because their own stock that their own, you know, business is into buying and selling cars. So for them, motor vehicles is an inventory. So you have to be careful about this. Accounting is really very, you know, simple if you understand your principles. Okay? Right. So we're clear. So it's used for stock valuation, and we know, of course, stock valuation, we use LIFO. Sorry, we use FIFO and weighted average. But then LIFO is not allowed as per IFRS 2. Okay? So one of the benefits of absorption costing is stock valuation. So, and I already told you what is stock and how do you value stock. At the end of every financial year, you will count your stock that remains in your warehouse. Okay? and those stocks will be counted and they will be recorded, you know, and of course they will be compared to each stock. You know, every stock item that you have has got a stock card that is kept, that monitors inflows and outflows, that monitors the stock that comes in and stocks that goes out. So at the end of the financial year, inventory will be done. By inventory, we mean counting the stock that remains, and then you try to reconcile the whatever counts you have, you try to reconcile it with each stock sheet to ensure that whatever is written, whatever is recorded in that stock sheet is what is counted. Okay? And after counting and verifying everything in real life, what do? We value them. Okay? So we value them. So we can use FIFO. FIFO is what? What is FIFO? Let's try to recap our accounting knowledge. What is FIFO?
First in, first out.
FIFO will mean like exactly, first in, first out, which means like the first.
Okay, and what do you mean by first? It's easy to say in your tongue, first in, first out. But what does it mean to say first in, first out?
It will mean.
Adama, wait. I want to catch you. Adama Jadama, what is first in, first out? We are all accountants, man. Come on. Sorry, it's not our Adama Jadama. Sorry, it's our Jadama. Are you with us? Are you with us? Okay, I'm going to pick at random so that I'll try to catch some people. Right. Ibrahima M. Tarawale. Ibrahima, are you with us?
Yes, I'm with us.
Okay, so can you explain to us, can you explain to a non-accountant what is first in, first out method of stock valuation?
The stock of valuation in which the goods that come in first into the business are sold out.
They are sold out.
Yes.
Do you agree with him, class? Do you agree with him? The goods that come into the business first are sold out, and that is what is meant by first in, first out of stock valuation. Is that the case, class?
Not very sure.
Actually,
no, it's incomplete.
It's incomplete. Okay, can you complete it, please?
No, what this means is that like the first assets that comes into the business, like that the business brought into its operation, are the ones that they sell out first before selling out the preceding one that comes later.
Okay. Right. Okay, but I need more explanation. Okay. Hadi Job, Hadi, are you with us? I'm going to pick at random. Hadi, are you with us? Hadi?
Yes, sir.
Yes. Can you give us how to call it, some explanation of first in, first out?
It's a type of stock valuation in which the first stocks that are bought by the business are first.
Sorry, we are not hearing you clearly, Hadi. We are not hearing you clearly. Can you?
I said it's a type of inventory valuation or stock valuation in which the goods that are bought first by the business are the first to be sold out at the price they bought it before they sell the other goods that are bought after the first inventory.
Okay, can you repeat that again, please?
I said it's a type of inventory valuation or stock valuation in which the businesses, the goods they bought for the business at first are sold out at a price before selling out the other goods that they buy at that price.
Okay, fine. Let me just make this clearer and then we can move. Okay, first in, first out method of stock valuation is a method of stock valuation whereby the business assumes that whatever stock that comes in first, okay, are the stock that goes out first. So for example, if you buy stock, let's say on 1st January 2020 or 1st January 2021, right? And then later on you bought some stock of goods, let's say on 3rd of February 2021. So you are assuming that those stock that you bought on 1st January will be the first one that will be sold. Okay? So as such, when you do your valuation, you assume that the ones that came first will go out, okay? And so whatever remains, whatever stock that remains will be the stock that will be the ones that came later. So as such, the price you will use to value your stock will reflect market value. Okay, as simple as that. So unlike the LIFO, which is last in, first out, so it's like you're assuming that the stock of goods that come in last are the ones that will be sold out. You know, naturally that doesn't make sense. In fact, in real business life, the goods that you bring, even when you go to the shop, the supermarket, when you go to supermarket, always observe the stock that comes in front, okay, in front of the of the aisle of each of the item are usually the stock that are nearing expiration. So if you want to buy milk, for example, if let's say you want to buy yogurt, let's say Ardo, if you want to keep it for some time, when you go to supermarket, don't pick it from the first one you will see. Okay, I'm telling you a trick. Don't pick it from the first one you see. But if you want the one that's going to last long, pick it from the back, because they arrange it in such a way that the ones that are nearing, the ones that's expiry date are near will come first, so that they can just eliminate them. So it's the same principle, first in, first out. I hope it's clear. Okay?
Yeah, it's clear.
Good.
Yes.
Can you briefly go through it again? Someone called me and my connection was disrupted when we entered.
And you know, that's not our problem. You should make sure your connection is okay. Right. So I will repeat it, but it's like if I want to keep repeating, we won't finish what we supposed to, finish. Right. So what I was trying to explain is first in, first out. Okay. So first in, first out, like I explained, is the first stock that you buy are the ones that will be sold off, early. So that if you buy stock in January and you buy some stock in February and so on and so forth, the stock that were bought in January will first be the ones that will be sold off. So this is the assumption you put when you are doing your FIFO method of stock valuation. Show that because what you use, if it is the same item, you'll use the unit price of that stock to value whatever quantity that remains. Okay? So in the FIFO method, the unit price that you will use to value the stock that remains to count at the end of the financial year will reflect the current market value, because it will be the unit price that will be on the stock that came in later, not the ones that came in earlier. So that's why LIFO is not allowed, because LIFO is the opposite. In LIFO, you do your valuation based on last in, first out. So the ones that came in early will go out first. That's not a good business technique, like I was explaining in the case of supermarket. So if you use LIFO, that means your stock valuation will be on all the unit prices, which would not reflect the true value of the stock. I hope it's clear.
Yeah, it's clear.
Okay, excellent. So we move. So the second benefit of absorption costing is for pricing, to price our goods. Okay, if, for example, you are a book production company. You want to price the book that you're going to print and sell to the public, or maybe a customer comes and places an order. Okay, if the customer comes and places an order, I want you to print, let's say, a novel for 1,000. Sorry, a novel, 1,000 pieces of a novel. That's what I want you to print for me. So you will do your costing. You will look at your direct materials, which will include the paper, the ink, and stuff like that. And you look at the labor, the direct labor cost. That will be the cost of labor that the production staff, are going to, spend on that particular order. Okay, and then we will look at the the overheads. The overheads will include the rent of the building. Okay, let's say you are hiring a machine, the hiring cost of that machine, which of course have to be apportioned before you can apply it to the product. So you put all direct costs or all variable costs together, you add the fixed cost to them, and of course you divide it by the unit, okay, 1,000 in this case, and you put a markup. Markup will be a percentage usually. You say, I have done my costing and I arrived at a unit cost of $200, but our policy is to add 10%, markup on cost as a profit. Then you calculate 10%, which will be $2. So you'll say, $2 plus the 200. Sorry, not $2, $20, so will be 220. So you'll say my selling price will be 220. But the only problem with using the absorption costing technique as a selling price, we will come to see it when we look at our target costing. It does not factor what prevails in the market. For example, if the book you calculated using absorption costing and you arrive at a unit cost of 220, okay, but you've not made any research to see how your how your competitors, printing companies are printing that kind of novel. Some may be printing it at say 180, some may even be printing it at 150. Okay, so by doing that, the customer will come and say, okay, wait, okay, tomorrow I'll call you, and tomorrow will never come. Why? Because you've sent the customer away. How did you send the customer away? You use absorption costing technique in your pricing decision without factoring your target costing. Okay, so when you look at target costing, you will see, you will know what I'm talking about. The target costing will consider what prevails in the market, and it will determine the selling price, and it works backwards so that whatever product that you're going to produce will be marketable. Okay, so these are some of the little things that you could use to go and advise these small businesses. There are a lot of corner shops that are overcharging people, and we are in that crisis at the moment. Okay, what they fail to understand is if it is fast-moving goods like rice, oil, cement, and so on and so on, you may not have any problem, especially when there is shortage. But if it were other non-fast-moving goods, you're going to have problems. You'll be, gathering, your products will be gathering dust in the south because nobody's going to buy them because they are too expensive. Okay, so it's very, very important to know these techniques and try to apply them in practice. Okay, I hope it's making sense to you, class.
Yes, yes.
Okay. Excellent, excellent. So it can be used also for budgeting and variance analysis. Of course, when you're doing your budgeting, what do? You do a lot of costing, isn't it? You're going to do a budgeting, you do a lot of costing. So when you're doing your costing, you use what? Absorption costing. You know, so absorption costing is very useful in budgeting and variance analysis. I hope we all know what is budgeting and variance analysis. Okay, budgeting, class. When we talk about budgeting, Adamaba, sorry, Amaduba. Amaduba, are you with us? Amadou? Ibrahim Drame, are you with us? Ibrahima?
Yes, Mr. Favar.
Yes. We are asking a question about budgeting and variance analysis. What's the difference between budgeting and variance analysis?
Budgeting is a way of forecasting.
Okay, it's a way of forecasting.
Predicting of what company want to achieve or intended to do.
Okay, good, that's good. So, and you don't only budget your cost, but you budget your revenue as well. Okay, what about variance analysis?
For that of variance analysis, these are different variables that combine, in combination of different variables.
What do you mean by combination of different variables?
Cost, different cost, like variable cost, fixed cost, and other costs.
Variance analysis.
Project to, yes.
Do you agree with her? Do you agree with him?
No, sir.
On variance analysis?
No, sir.
No.
Fatu, can you tell us what variance analysis is? Fatu Kamara?
Okay. In my own understanding, variance analysis can be difference between your two variables. That's your actual and your budgeted.
Okay, very good, Fatu. So variance analysis is the difference between your budget and your actuals. So it could be your actual income, and it could be your actual cost. So you compare what you budgeted to your actuals. For example, you could budget to make a revenue of 500,000 in a year, but instead you were able to make a revenue of 400,000. So from 500,000, it has gone down. Will that be a favorable or adverse variance?
Adverse.
But you have come down. You have come down.
Well, it's talking about revenue.
It's favorable.
Not cost.
Ah, you see, I'm confusing people. Cham is saying that it is favorable. Cham, we are talking about.
Okay, I did not.
Are you sleeping or?
I did not hear that properly.
No, we are talking about income. You budget to make an income of 500,000, but you are only able to make 400. That is adverse. Okay. On the other hand, if your salary budget is, let's say, 200,000, but at the end of the year, your actual salary cost went up to 250,000. Is that an adverse or?
Adverse. It's also an adverse.
Yeah.
It's also adverse. But if your salary budget has gone to you budgeted 200,000 and you spend 180, will that be favorable or adverse?
That's
That one is favorable.
That one is favorable. Good. So that is what's budgeting and variance analysis for you. So we use absorption costing in doing that as well. Okay, so let's move on. I want to make the class as interesting as possible. Okay. So any questions or any remarks before we move? Yes. Any